Okay, good morning, ladies and gentlemen. So, this is the last lecture that I'll be taking. Next week, Gary will return, and he will complete the lecture material that you need to know for your examination. So, the only bit that remains after we've covered this topic on what are basically other type of options and futures contracts we haven't really studied in any detail is swaps. And swaps is a very small topic. So after that, basically, the remainder of the semester will be spent learning how you actually perform trades in the virtual trading platform and prepare you for your trading game that you participate in. So what we're going to be covering today completes basically the majority of what you need to know for your exam. I don't set the exam, so if you have any specific questions about that, you might want to speak to Gary. But the reason why we include this topic, or Gary includes this topic, should I say, is because it gives you a feeling that if you know how to price what we call plain vanilla options and futures, then you should be able to actually price and value mostly any other type of option and futures contract that is out there in the market. The reason being, they all rely on the same type of information. In particular, there are two equations that basically determine how you calculate most type of options and futures contracts. So, what are they? They're the Black-Scholes-Merton model that you've studied, and on top of that, there is also the futures model that we had a look at the last couple of weeks. If you know those two models, you can combine them and split them up in different ways to calculate many other type of options and futures which are not commonly traded. So, what we've studied so far in the course are those options and futures which are regularly traded in the derivatives markets around the world. And they're referred to as plain vanilla derivatives. We call them plain vanilla because, I guess, in the English language, vanilla ice cream is considered to be the basic flavor that you have when you go to an ice cream shop. But if you want something special like chocolate or strawberry, then it's considered an exotic. So what we're effectively going to be looking at today are exotic derivatives, or at least those which are not traded as often. The exception is, though, our currency derivatives I'm going to cover. They are traded quite often. So what are we going to look at in specific? We're going to start off by looking at what options on futures contracts are. Options on futures, as the name suggests, are a derivative on a derivative. So if you purchase an option on a future contract, then, as the name suggests, if you decide to exercise the option, you get a futures contract. And that futures contract, of course, is on a spot. So there's three levels here where you've got the spot, the futures, and the option are all relying on each other. The second type of derivative that we're looking at will be that of foreign currency options and futures. And in order to understand how they function, we have to cover two particular type of topics. One is referred to as triangular arbitrage, and the other is interest rate parity. The reason why these two are important is because if we want to know how we price derivatives, we have to understand how interest rates are set, sort of, between different countries and the impact that has on currency. So that leads us to look at currency derivatives, both options and futures. Then I'm going to finish off looking at other type of what are called exotic options. Exotic options don't necessarily mean that they're hard to calculate. The reason being they're called exotic is actually more to do with the fact that they are not traded very often in exchanges. So although you can very easily purchase the options and futures we've looked at in exchanges around the world, these ones I'm going to talk to you about are primarily OTC, so over the counter. They're not heavily traded, and if they are, they're usually between individual parties, between banks. Okay. So, as I've already mentioned, if you know how to calculate basic plain vanilla derivatives, then you can essentially calculate any other type of derivative that's out there that we have not covered in the course, because they're all based on the same thing. You need to know the futures pricing model and the Black-Scholes-Merton model, both of which you have covered extensively in the course. So the first one, as I mentioned before, we're going to look at are options on futures. They are also sometimes called commodity options or futures options. They can have these two names. And as the name suggests, as I mentioned before, the option is not on the stock, for example, but on the futures contract. So if, for example, you have decided to go long position on an option on futures call, then when you exercise, you receive a long position in the futures contract. And this leads to one major fundamental difference when we look at options on futures to other type of options, such as stock options. So the best way for me to explain it, I've got an example here, but I don't think it's the best way to go through it. So I'm going to explain it via a simple graph. If we have a look at a situation where we've got time here on the horizontal axis, and let's say the option on futures contract matures at time large t and has an exercise price of X. If on the horizontal axis I've got time, what should I have on my vertical axis if I'm looking at options on futures? Futures, right? I should have futures prices, not stock prices, because the option on futures is on the future. So here we have futures prices. Now let's say that the option on future, the futures price itself, started off quite low when we purchased the contract, small t is equal to 0, but now is up here. Is this option on future in or out of the money? Simple question. In the money, right? The futures price is above the current exercise price. Now, if this was, let's make up some figures here. Let's say the exercise price is $5 and the current price of the futures contract is, let's say, 8. So, if I were to exercise a stock option where the stock currently is priced at $8 and the exercise price is $5, what is actually the process that takes place? If I decide to exercise today, what do I have to do? If I exercise today, what do I do? What is the actual thing that happens? So today I decide I'm going to exercise. Do I have to give anything? Really? You have to give the money, right? How much money do you have to give? Sorry? $5, right? I have to hand over $5, and in return, what do I get? I don't get $8. You get the stock, right? And then what can I do with the stock? I can then sell it, right? I can sell it for $8, making a $3 profit. So the theoretical value of an option that is exercised today at time small t is going to be $3. But the process involved is slightly different. I have to pay $5 for the stock, right? Okay. Now, if this stock option is an American option and you can exercise early, would I choose to exercise early? No. What would I do instead? If I think the stock price is going to go down, what would I do instead? I would sell. Why would I prefer to sell rather than exercise? Very good. So, we have what we call the time value of the option, right? There is still time remaining, so let's call that TV, time value, there's still time value remaining of the option, and therefore the price of the option, if you were to sell it, should be equal to its intrinsic value. What's its intrinsic value? $3 plus the time value. So it will be worth more than $3, right? That's why we know the lower boundary condition of a call option is going to be 0 if it's out of the money, or the stop price minus the exercise price for an American call option. That's the minimum value, right? The bare minimum is going to be $3 plus the time value. So we know that basically that with a stock option, we're not going to really want to exercise early, right? Just out of interest, when would you exercise an American call option early? Dividends, when dividends are paid, right? So if dividends are paid, then you may wish to exercise early. In fact, let's be a little bit more specific. So that's sort of training here for your exam. What condition would need to be the case for you to exercise an American call option early? There is a dividend paid. What's the condition, though? What is the size of the dividend that needs to be paid? It's not, it is, well, I mean, relative, yes, it has to be large relative to what? If you think about it, the answer is here. I've already just talked about it. Yes, the dividend that is going to be paid has to be of greater value than the time value, right? If the dividend paid is smaller than the time value, then it's better for you to hold on to the, well, just to sell it, right? If the dividend is larger than the time value of the option, then you're better off exercising. So that's the condition. The dividend has to be relatively larger than the time value of the option. Okay. Okay, good. Now, let's switch our attention to an option on futures contract. With an options on futures contract, when I exercise my option on the future, where the future currently is priced at $8, what is the process? What happens? The option on future gives me the right to do what? The call option on future gives me the right to do what? To buy. To buy what? To buy the futures. Okay, good. So explain the process, just like you did for the stock. I buy the futures contract at what price? Not zero. I know what you're saying, but my question is slightly... I buy the futures contract at what price? $5, right? How much do I pay for it? Zero. I pay nothing now for it. What do I receive? The futures contract, right? Okay. I pay $5 for the futures contract. When do I pay for it? Later on. In fact, when do I pay for the futures? Time large T. So the difference between the stock option and the futures option is that I am not paying any cash now to establish my position. However, theoretically, I've made a $3 profit. If I purchased a futures contract today at $5 but don't have to pay for it later on, but the futures contract is priced in the reality in the market at $8, that means it has a value, a futures value of $3. When do I receive that value? Sorry? No. Very good. Because of daily settlement, every day, if you have made money or if you have lost money, then you either get money put into your margin account or taken away from you. So if you recall, I explained that when we look at the value for a futures contract, it's different from the value of a forward contract. So if I have value here on my vertical axis, then what we know is that the price of the futures contract may go up or it may go down. If it goes up, then the value during the trading day will increase. But at the end of the day, the value always goes back down to zero. Why does it go back down to zero? Daily settlement. So in any given day, you may make money or you may lose money. But that is settled whether you make or lose money at the end of the day. So the thing is this, and it's important to understand. I mean, this could be like a type of question you can get in the exam. The difference between, the fundamental difference between an option and future and a stock option is that if you exercise a options on future contract that is in the money, you will receive cash with no outlay. Immediately, you receive $3 at the end of the day. So, would you exercise, when would you exercise an American options on futures contract early? Not before the dividend. It may be before the dividend. It could be, but it's not the when it's in the money, right? Now you might say, when in the money? Well, it has to be, and this is the key, you want to write it down, it has to be sufficiently in the money so that it offsets any time value. With a stock option, let's go through this again, with a stock option, you will exercise an American call option early if the dividend payment is going to be larger than the time value of the option. You'd rather exercise than sell. With an American option on future contract, if the option is sufficiently in the money relative to the time value remaining of the option, you would exercise. Those are basically the conditions. Same idea, but the approach is different. The reason being, by exercising, you immediately establish a $3 profit and don't have to pay for the contract until later on. So you're getting money straight away. So, then the question is, why is this occurring? And it goes back to a mantra, you know, that I'm sure Gary introduced you to, which is that calls theoretically save you money, right? Call options save you money. Why do they save you money? Because you're delaying the purchase of an item. Rather than buying the stock today, you buy it later on if you hold a call option. So you can save your money in the bank earning interest. Options on futures contracts do not necessarily save you money. Because now, if you exercise, you get $3 and then you can put that money in the bank earning interest. So options on futures do not necessarily save you money. There's a fundamental difference between these two things. So that's the main thing that you have to understand between, for example, stock options, even interest rate options. We don't really spend any time on that in the course, but they're the same thing as stock options, versus options on futures. Options on futures are different because you may wish to exercise early if they're in the money, and it's due to the fact that they do not save you money. So that's basically the answer to the puzzle that I've sort of just gone over. Okay. If we have a look at the formulas for options on futures contracts, they are pretty much identical to what you've already covered in the course. As I said before, if you know how to calculate plain vanilla options and futures, you can pretty much do most other things. So, the minimum value of an American call option on futures is going to be not 0 if it's out of the money and S minus X, but instead F minus X. Because, of course, the options on the futures contract, so the underlying is the futures. We're going to be interested in the futures price, not the stock price. For a put, it's going to be 0 or X minus F. What about the lower boundary condition of a European futures? Well, now, it's equal to 0 if it's out of the money, or the present value of the futures price minus the exercise price. And you may ask, how did I actually derive this? How did I get this value here? Well, what I did was substitute in my futures formula for the stock price. So let me just explain. This is very simple algebra. It's nothing complicated. We know that, let's say, we're trying to price a future and there's no convenience yield. So there can be convenience yields if you want to. I'm just making it simple. In which case, the value of the future, not the value, sorry, the price of the futures contract is going to be equal to the current spot price plus what? What am I missing? Interest foregone. Interest foregone. So I'll add that here. Right? I can also express it this way. It's the same thing, right? If I have dividends being paid, then I may want to say something like this. Right? Okay, here I've now got a convenience yield, right? Or, right? So, but just to make things easy, let's just start off with this one here. And if we rearrange the formula and solve for S, then I can say that S is going to be equal to F over 1 plus R to the power of, power of T. And I can rearrange that slightly. So it's just very simple algebra. I'm not doing anything too complicated. There. So now the stock price is equal to the futures price discounted, right? What I'm going to do is substitute for S this equation here, this little formula here. So if I say that the maximum value of a European call previously would be 0, or the stock price minus the present value of the exercise price, what I'm now basically saying is that it's going to be equal to the maximum of 0 or the present value of, what have I got? Did I put down the futures first? Yeah, the futures price minus the exercise price. That's all I've done. Because now I have present value of futures price minus the present value of the exercise price, right? So I'm just simplifying it. And that's what I've got here. Present value of the futures price minus the exercise price. So I've substituted the futures formula inside my options boundary condition. As I said before, from the start of the lecture, there's only two formulas you really need to know. The Black-Scholes formula, of course the lower and upper boundary conditions, and the futures formula. And with that you can create anything else you like, basically. Okay. For a put, it's the opposite. The present value of the exercise price minus the futures price. We can also show that put-call parity holds for options on futures. I can create two portfolios. I can take a long position in futures contracts and a long position in put, and compare that to another portfolio of going long in the call and taking out a position in bonds. So, initially, when I take out my long futures position, the value is equal to 0. Can someone briefly explain to me why is the value equal to 0 for long futures? Yeah, you pay nothing now, right? You pay nothing now, and the futures price hasn't changed. The long put is going to cost you the premium of the put. The long call is going to cost you the premium of the call, and the amount of bonds you need to put in the bank is going to be equal to the present value of the exercise price minus the futures price. So that at expiry, at time large T, you end up with the value in the bank being equal to exercise price minus futures price, right? Because you're going to earn interest. How much interest? You're going to earn this amount of interest here. Okay, so in the future, the futures price can be below the exercise price, or it may be above the exercise price. Well, It doesn't matter for the futures contract whether the options are in or out of the money. What you get is going to be equal to the basis, right? It's going to be equal to the final futures price minus the initial futures price. That's your return. That's going to be your value. For the option, well, essentially it's going to be in the money if it's a put option, if the exercise price is bigger than the futures price, so you'll get X minus F. Otherwise, you get 0. For the call position, it's the opposite. If the exercise price is bigger than the futures price, you get nothing. If it's smaller than, you receive the futures price minus the exercise price. So if you have a look at the total net position of portfolio A and portfolio B, they are in fact identical. They give you the same payoff. If they give you the same payoff in the future at expiration, then that must mean what? So the whole purpose of doing proof by arbitrage, which is a special way of proving things. So in mathematics you can prove things in many different ways through inductive, deductive reasoning, but the way we can actually do it in finance is quite unique to the discipline. We can tell whether conditions, whether certain relationships hold by arbitrage. If we know in the future both portfolio A and portfolio B give you the same payoff, what does it tell us about the value of portfolio A and B now? They have to be the same. They have to have the same value. So we can prove that a long futures plus a long put is equal to a long call plus a bond, because we know for certain that in the future they give us the same payoff. So that's what proof by arbitrage is about. So this essentially proves that put-call parity is maintained. A future plus put is equal to a call plus a bond. Or alternatively, we can rearrange the formula to say a put is equal to a call plus the present value of the exercise price minus the futures price. This is very similar, of course, to the standard put-call parity for options on stocks, except for, of course, it's not just the present value of the exercise price, it's the present value of the exercise price minus the futures price. Or you could say futures minus exercise price. It's the same thing. Okay, this slide covers what I've already talked about. This is the fundamental difference between options on futures and stock options, which is to do with early exercise. You may very well wish to exercise an option on a future contract early because it establishes frees up money that you can then put in the bank. So I've written down here that, well, I didn't personally, that deep in the money calls may be exercised early. Technically speaking, this is not correct. The option doesn't have to be deep in the money. It has to be in the money so that the money that you free up from exercising is greater than the time value lost from exercising. Okay? And the similar arguments also hold for puts. Same thing, you may be freeing up cash if you exercise a put option. They're identical, put and calls in the way I've just talked about them. So now we come to the actual model. And the model is referred to as the Black model. The reason being, I presume, that Black basically made a small modification and just named it after himself. So he basically said, forget about Merton and Scholes. So the Black model is the model that we use for pricing futures. And if you look at it carefully, particularly for D1 and D2, they're in fact identical. You can use whatever option pricing calculator you have to work out an option on future contract. The only thing to remember is that you don't put in the stock price, but rather the futures price. Everything else is the same. The call option is equal to the present value of the futures price minus the exercise price. If I go back again, I'm just basically saying this. I've rearranged that a little bit. So present value of the futures price minus the exercise price. That's what this is saying here. Present value of the futures price minus the exercise price. The only difference is I've inserted ND1 and ND2. ND1 tells us what, in fact, can you tell me, what does ND1 stand for? So probability of what? Yes? Okay, it's close enough. Probability that the futures contract, I made a mistake there. Probability that the option will be in the money at expiry, right? That's what the definition is of ND1. Probability that the option will be in the money at expiry. ND2 is basically the same as ND1, but a little bit less. It's worth a little bit less. It doesn't have a natural interpretation. So what I've done is inserted ND1 and ND2 into my lower boundary condition, and I end up with the value for a call option on futures contract. Okay. Note that with the same expiration for options on the spot as options on futures, this formula gives the same price. Black's model only works when futures and options have the same termination date. The reason I point this out is the following. When we start looking at these other type of contracts, particularly the exotic contracts, you can create many strange contracts that become very difficult to calculate. And in particular, I'm going to be talking about a section of those which are referred to as path-dependent options, which are complex to calculate. The more complicated an option or a derivative in general is to calculate, what impact do you think that will have on the demand for the derivative? Do you think more people or less people are going to be interested in trading it? Less, right? So the more complicated you make something, the less interested people are going to become, because you're going to not be sure how to work out the value of the derivative. It makes sense. So when we start looking at these more exotic type of derivatives, by and large, you want to keep things as simple as possible, because if they're made too complicated, people don't know what to do in working out the value. The reason I say this is because of the following. Have a look at this. In this equation here, I have how many termination dates? 1, right? This implies that the futures contract must terminate at the same time as the option on the future contract. If it didn't, I would have to take that into consideration as well, and suddenly my model would be a lot more complicated. So when you look at options on futures which are traded, for example, they are traded here in Australia. You can purchase, there's a liquid market on options on futures here in Australia. You will find that the futures contract terminates at the same time as the option contract. The reason being, if it doesn't, then the formula becomes a lot more complicated than what I've presented, and people become hesitant. They become a little bit wary of trading them. So, by and large, these options and these futures contracts that we look at are kept as simple as possible to increase liquidity of these derivatives. Same reason, for example, let me give you a question here. Why is it that the majority of index stock options in the market around the world are European? Index stock options tend to be European. Why is that? Well, if we look at the underlying constituents, so what makes up an index, what is it made up of? What's an index made up of? Lots of stocks, right? And do you think, therefore, there's going to be just 1 or 2 dividends being paid, or many? Many, right? So the problem is this. If you purchase an American index option, then every day you have to check all the dividends which are going to be paid, right, in the next month or two, and work out individually, do I exercise before or after each one? Basically, you're creating more work for the trader. For someone such as yourself, you take a long or a short position in the index option, you have to do extra work to work out whether it's worth it or not. With a European index option, you don't have to do that. You know you have to hold till expiry. So they do it on purpose to increase the liquidity, to increase the likelihood that you're going to purchase that. Now, most stock options are American. The reason being, at most, you will find a stock paying dividends 4 times a year, at most. The majority will pay maybe only twice a year. So that you can easily count, you can easily deal with. But an index option, a big, large number of stocks, you have a number of dividends being paid every single month. So this is just another example I'm trying to highlight. You want to keep things simple if you want to ensure people trade it. The more complicated it is, the less people are going to be sure about the value, and therefore they're going to stay away from the contract. Okay. So that basically concludes our little discussion on options and futures contracts. So what we're going to do is move on now to look at currency derivatives. Now, most people have a problem in understanding how currency derivatives function because they get confused about what an exchange rate is. The exchange rate is the rate at which a currency of one country can be translated into the currency of another. But the way you should view it is that it is the price in one currency of purchasing any other type of currency, and it's similar to that you do for any other type of asset. So let me explain. If I decide to go into a shop and I use my $1 Australian to buy a pen, that's nothing different from me going into a shop and purchasing a euro, for example, or an American dollar. It's exactly the same thing. So I've got my money and I'm purchasing something else with it. But instead of purchasing a physical item like a stock, I'm actually purchasing some other type of currency. That's the only difference. So if you keep that in mind, then you'll basically realize that what I'm going to show you very soon is that all the formulas that we've already covered to calculate futures and to calculate options are identical. There is no difference in the formulas to calculate a foreign currency option than it is to calculate a stock option. The only difference is that you're not looking at the stock price. You're looking at the price to purchase another item. And we call that the exchange rate. That's basically it. So, in order for us to understand, though, how the currency market functions, we do have to look at a couple more extra things. The first is to appreciate the fact that what we're talking about is referred to as the interbank market. It's the market where banks around the world, plus also individuals, trade their currency for another currency. And the value of it is in excess of $10 trillion a year. It is, in fact, the largest financial market in the world. Larger than stocks or bonds or anything else you can think of, the currency market is the largest in the world. And it started, and we discussed a little bit about this earlier in a previous lecture, in the 1970s. What happened in the 1970s? That's right, Bretton Woods, the gold standard, right? Currencies were no longer pegged on gold. So nowadays, for example, the Australian dollar, what is it based on? Nothing. It's based on confidence. If you have no confidence in the economy, you do not hold the Australian dollar. You buy some other type of currency. Right. There are, in fact, only 5 major currencies which are traded around the world. That's the US dollar. That is by far the largest, followed by the euro and the yen. And then after that, there's a very big jump down, and you get a much smaller proportion of those trading Swiss francs and British pounds. Now, the reason I'm pointing this out is because you can only trade your currency for another currency via one of these currencies here. What do I mean by that? Well, most of you here are from China, so if you get your renminbi and you want to convert it into Australian dollars, then what you'd have to do is convert it first into US dollars and then into Australian dollars. So this is referred to as a cross rate. The majority of currencies around the world are in fact what we call, the rates are called cross rates. There is a rate that's determined by going through one of these other currencies. This is the same for the Australian dollar. If I want to convert my Australian dollar into, let's say, Malaysian ringgit, Malaysia and Australia are two very small economies. So, for example, Australia makes up, in terms of market capitalization, just to give you a feel, what do you think is the proportion of the world's market capitalization here in Australia? What percentage do you think it is? How much does Australia make up of the world's market capitalization? Yes, you're right, 2%. 2% of market capitalization is Australia, right? So even though Australia is I think like the 12th largest or 13th largest economy in the world, it's still basically meaning the other 10, 12 economies in front of it are much more larger. So there is no demand. There is no demand for trading Australian dollars with any other currency. So if you want to trade yours into Malaysian ringgit, you cannot do it directly. The market is too small. You have to go and trade it first into US dollars and then into ringgits from there. Now, here in Australia, we would primarily be trading our currency in US dollars or in yen. The reason being, those would be the most likely currencies for trades. The rest basically are relatively smaller, within Southeast Asia at least. So that's the difference between a cross rate and a direct rate. If I hold US dollars and want to convert it into euro, then I do it directly. That's basically the idea. Now, in order for cross rates to function, you must ensure that there is no such thing as triangular arbitrage. What does triangular arbitrage mean? It means that you cannot convert your currency into another currency and then back again and make money. So, for example, if I have, let's say, Australian dollars, and I convert those Australian dollars into yen, and I get my yen and I convert it into British pounds, and then I get those British pounds and convert it back again into Australian dollars, I must end up with the same amount of money, excluding commission, right? Excluding transaction costs. The cross rates must be identical. They must basically be what we call unitary. Unitary essentially means 1. They must equal 1. The rates must total up to 1. If they don't, you can make money. So here's a simple example. Let's say £1 buys 268 yen and 1 Australian dollar buys 35 pence. So if I want to work out how much yen buys in Australian dollars, then I have to solve for this little equation here. I know that 268 yen buys a pound. I also know that 35 pence equals $1, and that multiplied by something, I don't know what that is now, but I know that equals 1, then I can solve for this, right? So I can work out that for arbitrage not to occur, then 1 yen must buy 1 cent, 1 Australian cent. That's basically how I work it out. Now, if you go back to the 1970s, when the currency started to be freely floating, so they were moving up and down, it was possible to make money from what we call triangular arbitrage. There are stories about how, in fact, students used to go to one bank, trade their money into one currency, then you used to run to another bank, trade it back, and make money. Why? Because they were not equal to unitary. They weren't equal to 1. So this basically doesn't exist anymore, of course, because very shortly after that, they made sure that with the computers linking up, you wouldn't be able to make a cross-rate trade and make money from it. So an example here of a triangular arbitrage, let's say that 1 yen doesn't buy you 1 cent but buys you 1.3 cents. So you could get £1, you convert it into 268 yen, and then you can convert it into Australian dollars, but at the 1.3 Australian cent per yen value, that gives you $3.60. Now if you convert that 360 cents back into pounds, which you started off with, you end up with £1.25. You have made a 25% profit. So what I'm trying to illustrate to you here is that this cannot be possible. Otherwise you have an arbitrage profit. Okay. So one component of understanding how currency derivatives are set is based on appreciating that currencies have to be set, cross rates have to be set against each other. They all have to be aligned with each other. The second bit is to understand this thing called interest parity. Interest parity is the relationship between the spot and the forward or futures prices of a currency. It is the same thing as the cost of carry for any forward or futures market. It proves that one cannot borrow or convert the domestic currency to another currency, sell a futures, earn the foreign interest rate, and convert it back risklessly, earning a higher rate than the domestic interest rate. The example I'm going to give you is a little bit more complicated than it needs to be. So I'm going to go through the example and then I'm going to basically summarize it to explain how easy it is to understand things. Technically speaking, this is the standard way of presenting what interest rate parity means. Let's say we've got the exchange rate, the spot rate, between the domestic currency and the foreign currency. In this example here, let's pretend that we live in Japan. So if we live in Japan, then we're earning yen. And let's say we're thinking of getting our yen and putting it into Singapore. So we're going to hold Singapore dollars. So the foreign interest rate is going to be the Singapore interest rate. The domestic interest rate is going to be that in Japan. So rho here indicates the interest rate in Japan. R here indicates the interest rate in Singapore. Sorry, got it the right way around. Rho here equals the interest rate in the foreign currency, which is Singapore, and R here is the domestic rate, which is in Japan. So, if I get some of my yen, because I live in Japan, and I buy Singapore dollars with it, the question is how much yen do I use? So the amount I use is equal to this little bit here. It's equal to the spot rate multiplied by 1 plus rho to the power of minus t. Why? Because when I convert it into Singapore dollars, I end up with this. So this is the conversion rate, right? So this drops out when I convert it into Singapore dollars, so I end up with this much. If I hold in a Singapore bank this amount of money for time period large t, I'll end up with how much? The bank pays rho interest rate. If I hold it till time period large t, how much do I end up with in the bank? 1 Singapore dollar. I end up with 1 Singapore dollar. So, I'm going to get my yen, convert it into Singapore dollars and hold it there for a period of large t. I'm guaranteed to make 1 Singapore dollar. So place my money in Singapore dollars in a bank earning the rho interest rate, the foreign interest rate. At the same time, I go short on a forward contract to deliver 1 Singapore dollar at time large t. And I will receive for that a price, and that price is F. At time t, my Singapore dollar is worth 1. My Singapore dollars is worth $1. My forward contract requires me to deliver that 1 Singapore dollar, and in exchange I will receive a certain amount of F yen. The question is, how much do I get in yen? Well, I've invested a certain amount of money in yen into Singapore dollars, and in return I would get a forward value, a forward price, which is going to be in yen. So in order for there to be a riskless transaction, the amount that I have to receive is going to be equal to the spot rate multiplied by 1 plus rho to the power of minus t. That's the foreign interest rate that I've earned for a period of t, multiplied by 1 plus r to the power of t. This is the domestic rate. So the explanation for a zero or no arbitrage price for the foreign exchange forward contract has to be equal to this. If you didn't follow that, I can explain it in probably a more simpler manner. This formula here is identical. This formula is identical to the formula if we were looking at an index futures contract, stock index futures. There is no difference. Why do I say that? Well, the price of an index future is equal to the index value, right? Multiplied by what? What's this bit here? Interest foregone, right? Interest foregone. What is this bit here? For index futures contracts, what's this bit? Sorry? No. We've done this before. We did it last week. They're the same thing. What's this? Interest rate. What's this? Yes, a convenience yield. In the case of index stock futures, it's the dividend yield, right? Right? Okay, so you have a convenience yield and you have an interest foregone. The convenience yield for index stock futures is, of course, your dividend yield, right? This is the same if you want to calculate a foreign exchange futures contract, except your interest foregone is the domestic interest rate. Domestic interest rate. And this here is your foreign interest rate. That's the only difference. Why is that? Let me explain the logic behind it. You have a choice. You can either hold yen or you can hold Singapore dollars. You cannot do both, right? You can't somehow, you've got money, you can either hold, you can keep it in yen in earning interest rates in Japan, or you can convert it into Singapore dollars earning the interest rate in Singapore. You cannot do both. Therefore, this is what it's saying. If you choose to hold Singapore dollars, then what are you foregoing? What are you losing out? The interest rate in Japan. So this is interest foregone. You are foregoing the interest you could have earned on your money in Japan. What are you receiving? You are receiving the interest rate you'd receive in the foreign currency. In my example, Singapore. Interest foregone, convenience yield. Okay, so the formula is identical, but the interpretation changes. So what you have to learn is the interpretation is changed, not that the formula has changed. The formula still remains the same. So, This is identical to an index futures contract. There is no difference. You've got interest foregone, and you've also got the convenience yield. The only difference is that the interest foregone is the domestic interest rate, whereas the convenience yield is the foreign interest rate. For currency options, it's very simple. Everything remains identical to what we've looked at before, as long as you remember one key aspect. That is, if you know how to calculate an index option, then you know how to calculate a foreign currency option. Index options, which we've covered already, index stock options, are identical in terms of the formula as foreign currency. So, the lower boundary conditions are identical, but this is not the stock. This is now the exchange rate. This is the spot rate between one currency and the other. This is not the stock price, this is the spot rate, the exchange rate. Here's our minimum boundary condition for a European option. It's the same as what it would be for an index option, the same formula. It's the spot price minus the present value of the exercise price multiplied by any dividend payments which are going to be made. But of course, in our case, it's not dividend payments, it's the foreign interest rate. Put call parity is the same. There is no difference. It's exactly the same. Here, this is you working out S/, the stock price or the index value minus the dividend payments, right? But now, of course, it's not the stock price minus dividend payments. It's the exchange rate minus the foreign currency interest rate. That's the only difference. And this leads us to the formula for working out a foreign currency option. It is, again, exactly the same to what you've covered. So if you have a calculator to work out an options price using the Black-Scholes model, you can use it just the same way as you would for working out a stock option. There is no difference. You just have to remember that now dividends are replaced by the foreign currency interest rate. That's the only difference. And the name, of course, also changes. So I like pointing this out. If you want to impress someone, they say, what did you do this morning? Oh, I learnt the Garman-Cohardin foreign currency option pricing model. But basically, it's exactly the same thing to what you've already studied before. So these two people basically realized, oh, you can use it identically, so they named it after themselves, basically. Okay, so we'll take a short break here, just 5 minutes, and when we come back, I will talk about some examples of exotic options, and that basically will conclude the lecture for today. Okay, so what we're going to have a look now at are some examples of exotic options, and I'm going to look at two different types of exotic options, and it's important to understand the difference between the two groups. You have path-dependent and path-independent options. Okay, I've got two binomial trees here, A and B. One of them is path-dependent and the other is path-independent. Can anyone tell me which one is path-dependent? Path-dependent. A or B? 50% chance of getting it right. A or B? At the moment I'm hearing A and B. A, path-dependent. You said that with very much confidence. Thank you. Completely wrong, unfortunately. So path dependence is B. Right. Why is B path dependent? So, if you have a look at the final outcomes here, they are dependent on, they rely on the path that you've taken. An upward movement followed by a downward movement gives you a different price than a downward movement followed by an upward movement. You end up somewhere different. They're completely different. Whereas in A, it doesn't matter what the path is for the final outcome. You can go up and then down, or down and then up, and you end up with the same price. Now, path-independent options are much easier to calculate because the final number of positions that you can have for the price is going to be equal to n plus 1, where n, of course, is equal to the number of periods that you're looking at. So if you've got 500 iterations, 500 periods, then you know you're going to have 501 final outcomes. With path dependence, it grows by 2 to the power of n. So very quickly, you will be spawning a very large number of final stock price outcomes as you increase the number of periods. Can someone give me an example of a path-independent option? Path-independent option. An example of a path-independent option. All European options are path-independent. Can someone give me an example of a path-dependent option? Yes, very good. Not just paying dividend. What type of option? American, right? American options where the stock pays a dividend. So you have definitely, I'm pretty sure Gary would have covered this with you. If you have a path-dependent option, like an American option where the stock pays a dividend, there is a trick you can use to convert the path-dependent process into path-independent, right? So the trick is that you have to discount the dividend payment, right? You don't use the stock price. Instead of, you use the stock price minus the present value of the dividend payments. And when you do this, you are very lucky because then suddenly you end up with a path-independent model. If you are stuck, if you can't do anything about it, you have a path-dependent model, becomes very complicated to calculate. And there's only one method that you can use that you've studied so far. So you've got the binomial model and the Black-Scholes-Merton model. Which model do you use if you have path dependency? Can you use the Black-Scholes model? No. You can only use the binomial model. So an example of that is what? There's one option you have covered where you can only use the binomial model. Which is that? American something options. American, not call, we just talked about how you can put, right? American put options, because at any point in time you have to work out if it's worth to exercise or not. When would you exercise an American put option early? When the price of the stock is sufficiently low, right, relative to the time value remaining. If the stock price is so low that the amount of money you can make extra from holding on to the option is smaller than the time value remaining of the option, then you may as well exercise now. So at every point in time, at every node, you have to work that out. You have to work out, do I exercise now or do I hold on to the option and maintain the time value, try to sell it. So, the reason I'm saying all this is because I'm going to look at two different types of exotic options. One which is path independent, and the others which are path dependent. Path dependent options rely on the binomial model. It can be difficult to work out. Path independent options are very simple, and we can use the Black-Scholes model. So the first examples I'm going to show you are path independent, and we can use the Black-Scholes model. So, moving straight on from there, let's have a look at two examples. These are really only traded in the US. I haven't seen them being traded in exchange elsewhere. So the first are referred to as digital options, and there are two types. Let's say we're looking at calls. You can have a call, asset or nothing option, and you can also have a call, cash or nothing option. So, as the name suggests, if you have purchased and gone long on an asset or nothing option and is in the money and you exercise it, what do you think you get? The asset. If it's a cash or nothing option, what do you think you get? The cash. Okay, so let's create a portfolio where we're going to go long. We'll go long on the asset or nothing option, and we'll go short on the cash or nothing option. So either the stock price can be smaller than the exercise price, or the stock price can be greater than the exercise price. So without looking at your notes, if the cash or nothing option is out of the money, what do I get? Nothing. If it's in the money, what do I get? What do I write down here? Not A, S. For cash or nothing option, if it's out of the money, what happens? Nothing. Yeah? Nothing happens. If the cash or nothing option is in the money and I've gone short on it, what do I write here? It is X, it's cash. Is it plus or minus X? Minus, because I've come a short position, right? So, in total, this is going to be, my payoff is going to be equal to 0 or S minus X. What is this similar to? Yeah, this is a normal payoff for a call option. So, as I said, don't look at your notes or whatever, but try to work out, therefore, what is the value, how do I calculate the value of an asset or nothing option? What do I do? I know that a cash or nothing option minus I know that an asset or nothing option minus a cash or nothing option equals a normal plain vanilla option. So, that tells me something. How do I work out the value for an asset or nothing option? This here is our formula that you should all be familiar with for the Black-Scholes model. The value of the call is equal to the stock price multiplied by the probability that the option will be in the money at expiry minus the present value of the exercise price multiplied by ND2. All that asset or nothing and cash or nothing options are is two components of this equation. The first component here, this is my asset or nothing option. It's the stock. The second component here is my cash or nothing option. It's the cash. So, an asset or nothing option is the first bit of the equation. The cash or nothing option is the second bit of the equation. That's it. So, if I go long on the asset or nothing, short on the cash or nothing, I put a negative sign here, I end up with your standard call option price. So that's basically an example of a path-independent exotic option. All I have done is basically get the Black-Scholes model and split it apart. And that's how most exotic path-independent options are. That's all that they are. All right, let's look at another example. This one is quite interesting, and it's called a chooser option. So chooser options, again, are primarily traded in the US. I haven't seen them here in Australia, for example. And you have two different periods that you have to focus on. You've got the termination date of the contract, but you also have another date, which is this, let's call this the chooser date. Okay. So, if you're here at time 0, you've just purchased yourself a chooser option, then what it tells you is the following. The chooser option can be a call, or it can also be, and it can also be, a put option. It is both. It is both. At the chooser date, you must make a decision. You have to choose. Do you want the option to either be or remain a call option or a put option? So for the remaining period of the time, it can only be one of them. So before, it is both. You've got a call and a put. For after the chooser date, it can only be either a call or a put. Now the question is, how do we work out the value, the price for this chooser option? Well, what must the chooser option be more expensive than? What must it cost more than? Just based on what we've studied, what would it be costing more than? If I compare it to a plain vanilla option, would be more or less expensive? More, right? It has to be worth more. So I can say definitely that a chooser option is going to be more expensive than a call or a put. A plain vanilla call or put, right? If I buy a put option or a call option, it's going to have to be cheaper than purchasing a chooser option. What do you think the chooser option will be cheaper than? And I'll give you a clue. Think about the trading strategies that we talked about a few weeks ago. What trading strategy is this similar to? If I go long on a call and a put, does anyone remember what it was called? Yeah, straddle. So, it must be cheaper than a straddle. Why must it be cheaper than a straddle? Well, if I compare a straddle going long on a put and long on a call, I would have the straddle for the whole period of time large, up to time large t, right? But for the chooser option, I only have a straddle up until the chooser date. After that, it is only a call or a put option. So now we know the boundary conditions. A chooser option must be worth more than a call or a put, but also must be less than a straddle. So then the question is, what is it equal to? Can someone give me an idea of how you would want to price this, just based on this information? What would you do to work out the value? If you were given the task of working out the value of this option, what would you do? This is a good exam question, but of course we won't use it in the exam. It's actually quite simple. The answer's there in front of you. Well, I'll give it to you. You seem to be struggling here. It'll be equal to buying a call plus a put that expires at time here, right, the choose a date, plus what else? Yeah, another, let's say a call option that starts at that lasts for a period of times choose a date till the large T. That's it. Done. The answer is actually written out here. Now you might say, well, hang on a second, I don't know. Okay, it's quite clear that the value of the chooser option will be call plus put up until the chooser date, plus one extra option, right? But do I choose the call option or do I choose the put option? Which one? Which, if I were to give you a choice, you can choose from me, I'm going to give you for free either a call option which is at the money or a put option which is at the money. Which would you prefer? Which one would you prefer? Call. And the reason being? Calls save you money. A call will always be worth more than a put if they're at the money. So if you're here at time 0, you do not know what the future provides. You should always, therefore, choose the call over the put because you know it has a higher intrinsic value. So the value of the chooser option is call plus put up until chooser date plus another call option that lasts from large T minus the chooser date. That is basically how you work out the value of a chooser option. I won't go through it, but I provide an example here for Coca-Cola in the US that's traded in the exchange to make a comparison. So you can look at it yourselves, but as you can see, the value of the chooser is going to be cheaper than a straddle, so I make a comparison, exactly what I've just done on the piece of paper there. Okay, good. So the next couple of examples I'm going to show you are of path-dependent options. And you may recall that path-dependent options imply that you do care how the final stock price arrived at its value. You want to know the path it took to get there. The path matters. With path-independent options, it doesn't. You don't care. The payoff is therefore determined by the sequence of prices followed by the path, by the asset, and not just by the price of the asset at expiration. We have to use the binomial model. So, the first example I'm going to give you are of Asian options. Now, as I'm sure Gary's pointed out, these continental names for these options do not imply anything about where they were created or where they're traded. In fact, Asian options are not traded in Asia. You can pretty much only trade them in London and in the US, as far as I'm aware. So the reason they're called Asian is just to differentiate them between American and European options. They are fundamentally different, just as American and European options are different, because they are path dependent. And they're based on the average. Now there are many different examples. You can have, for example, an average price option, where the final payoff is determined by the average price of the asset during the option's life. You can also have an average strike option, where the average price substitutes for the exercise price at expiration. So there are a few different types. So just to give you an example, to write one down for you, so it becomes a little bit more clear. Okay, so this would be an average price option. An average price option here is where your payoff, if it's in the money, is going to be equal to the final stock price. The final stock price. minus the average price that the stock has taken from the beginning of the option until the end. You can hopefully appreciate that this basically implies that you have path dependence. The reason being, of course, that you care every day what the price is going to be. You want to know what the price is going to be at time small t plus 1, plus 2, etc. Because it's going to influence whether you're going to make money or lose money. This is much more difficult than if all you have to do is look at a plain vanilla option such as a European or American, because the only price you care about for a European option, for example, is the final stock price. That's it. You don't care about what the previous stock prices have been. This is so much more easier to work out than this one here. Here, you're betting on what? What is your bet? If you go long on this average price Asian option, what are you betting on? You're hoping that the price, right, in let's say 3 months' time when the contract matures, let's say you're hoping that the price in 3 months' time for your stock is bigger than the average price it has been for the last 3 months. That's what your bet is. That is very different from making a bet saying, I bet that the stock price in 3 months' time will be larger than $5, but will be larger than a specific fixed price. That's very different. Okay. So average strike options work a little bit differently. You can spin this around. You could have, for example, it's the average price minus the exercise price. You could do it that way as well. You can do it either way. In any case, what I want you to appreciate is that this is much more complicated to calculate because you want to know what every single price is for the life of the actual contract. Okay. So when are they used? Well, they're useful for hedging and speculating when the average is acceptable, when you want to make a bet on the average stock price, not a specific stock price. Okay, the second example I'm going to show you are with regards to what are called look-back options. They're sometimes also referred to as no-regret options. There are many different types of no-regret options. You can have a minimum price for minimum exercise price. You can have a maximum exercise price. You can have what's called a fixed strike look-back call or a fixed strike look-back puts. They're all variations of the same sort of thing. What do they actually imply? Okay. Let me give you an example. Here's an example of a no regrets call option. When would you lose money in this example? When would you lose money? Exactly. The only time you will lose is if the final stock price basically is the lowest price that it's been at. So in every other situation, you're going to make money. So the reason why it's called a no regrets option is because it maximizes your payoff. Do you think no regret options are going to be cheap or expensive? They're going to be expensive. So there's not a big demand for them, but You have many different types. You can also maximize the price of the final stop price. You could do it this way. You could do max of S0 to ST minus an exercise price. That you could do as well. Maximum of what the stop price has been for a period of time minus the exercise price. You're maximizing the chance of you getting a payoff. So these are called look back or no regrets. The name suggests you don't regret them. You always make money. They tend to be in the money when they expire, and therefore the price is going to be much higher. The final example I'm going to show you are with what are referred to as barrier options. Barrier options have both two different types. There's many different types, but I'm going to give you a one that you've actually already seen before, and it has two exercise prices attached to it. So, if I were to go back here, you have a minimum exercise price and a maximum exercise price. And the way it functions is this: if the barrier option has a stock that goes above the minimum exercise price, then you get, in return, the stop price minus the exercise price. If the stock goes above the maximum exercise price, then the maximum payoff you will get will be that. It will be the stock price minus the maximum exercise price. So if the stock price is up here, you only get S minus X max. If the stop price is up here, you still only get stop price minus X max. What is this similar to in terms of a trading strategy? What is it similar to? It's the most popular trading strategy that exists for options. If you're trading options, you should know this strategy, because this is the way you do business, because you want to minimize the cost to you. Spreads. We talked about bull and bear spreads. So, a spread will give you a payoff that looks something like this. Let's say we're looking at a bull spread, right? This is a bull spread. So, how do I form a bull spread? Can someone tell me? What's the positions that I need? Yeah, long call with a low exercise price and shorter call with a higher exercise price. I can do the reverse with puts and get the same payoff. Okay, I can use puts as well. Why would I do this strategy? That's right, because I know the probability that the stock is going to go above a certain value is going to be small, right? So I may as well go long on the call for only the bit that I'm gambling on. The rest I short, and by shorting I make money. So I reduce the total net premium that I have to pay out for my position. So people very rarely go long on a call. When you're betting on the market, you're not using calls for hedging. You're using for speculating. Then I go long on a call, and at the same time I go short on a call with a high exercise price. Because I'm gambling, the price of the stock will be somewhere within this region. That's my gamble, and I want to minimize my cost of doing that. That is exactly what a barrier option does. The barrier option has two exercise prices. It has a minimum exercise price and a maximum exercise price. And the idea is basically simple. If the stock price goes above the first exercise price, it gives you a payoff. If it goes above the second exercise price, your payoff is held constant. It's equal to what that exercise price 2 is equal to. So the payoff of a barrier option is identical to that of a spread. So why would you purchase a barrier option? Well, the answer is, in many cases, people don't have a clue about the different type of trading strategies that you can create yourself. So when someone comes and says, hey, I will sell you a barrier option, will the barrier option be more expensive or less expensive than buying a call option? Less, right? So people say, wow, okay, this option is like a call option, but it's cheaper. I'm going to buy it. Now, of course, when you create this barrier option, you charge a little bit of extra money for your service. So suddenly, you're selling an option that the individual could have done themselves quite easily in the market, but they're doing it because they're selling it essentially to people who are a little bit naive, who do not know you can create it yourself. And they'll sell it for a slightly higher premium, and they make money from that. So this is where you start entering into these exotic options, which a lot of them are created to replicate the trading strategies that we've looked at. And they do this because the people, the clients who you're selling to, do not know they could do it themselves. So you're effectively trying to assist them creating what they want, and you charge a small extra service fee for that. So barrier options are basically spreads. And this comes to my last slide, and what I put down here is a whole heap of other type of options that do exist. They come with many different types of names. You could spend a whole week looking at all different types of options that are out there, but what I've done today basically is to give you the impression that if the option is path independent, then you can calculate it yourself using the Black-Scholes model and also the futures model. They're just variations from that. If they're path dependent, then you have to use the binomial model, and you have to think a little bit more clearly, what are they trying to do? Most of the time, most of these that I've listed here are actually replications of trading strategies that you can create, and they're just packaged up as a single option. Okay, so other than that, thank you very much, and I wish you success in your exam.